going on, everyone? I hope you're having a nice day, and thanks for stopping by for the very first episode of Option Insight's newest series, Brilliant Breakdowns, hosted by me, Aaron Brill. Brilliant breakdowns, Brill? No? All right, don't worry about it. So anyways, as a longtime subscriber and active member of the Macro Insights community, I'm just going to be dropping by from time to time to do my best to quickly break down some of the more advanced or sophisticated jargon you might hear Imran use rather casually. But, someone like myself and possibly you who haven't spent time decades inside institutional finance, we may not be as familiar with this jargon. So it's going to fall on my shoulders to come on here and break things down a little bit more for you in a more simplified retail investor sort of perspective. And that way you can follow along with advanced conversations like the ones you might come across in the weekly Macro Insight membership calls. As a matter of fact, we're actually going to use clips directly from the most recent weekly calls with Imran for the foundation of all of our brilliant breakdowns. And this way you can get a sense of how Imran uses a concept or a term in real time, seeing him do his thing in action, and then get a bit of a follow-up analysis from me to make sure that we're all on the same page. Make sense? All right. So let's get started with our very first topic for brilliant breakdowns. That's volatility divergence. So now you may be saying to yourself, oh, I know what divergences are. You're thinking about bullish or bearish divergence. And even if you are familiar with it, I feel as though, especially for new investors, it can be one of those things where you take for granted that you know what it means because you hear it all the time. So we're just going to take a little bit of time to quickly dig in and see what exactly we mean by a divergence. So let's go ahead. Let's cut to Imran. Let's hear him point out a divergence that he has spotted. And then we'll come back to me to make sure that we're all really understanding the significance of what Imran is pointing out.
And then for me, this kind of divergence between, and this bottom chart here, I've got the NASDAQ and I've got the Vixen, which is obviously the VIX of the NASDAQ. And you saw on that Monday low initially, that where it reached its highest level of around 43. But as we went to pretty much retest or get significant within a whisker of those lows on Friday, there was quite a shortfall on the vol, right? The vol was capped at around 38 on the Vixen. So that's what we call a volatility divergence, right? And we often see those volatility divergences when markets kind of retest their local lows and vols have already had their spike and they don't get anywhere near that level. That often shows you a bit of a sign of exhaustion to the sell-off. And then we went on to obviously NASDAQ has rallied pretty strongly off the back of that, right?
All right. So as you can probably see, there is plenty for us to digest in just that short amount of time. Things even like the Vixen or just the VIX, right? And then so if you're at a point in your investing career where you possibly need more details on the VIX, then I would say something like Option Insights Trading 101 series with Jack is probably a great place for you to start. For now, back to volatility divergence. Generally speaking, to deviate from something is to go off course or to go on a different path. So when you hear divergence in a charting or technical analysis context, it usually means that the price of an asset is deviating from a prior trend in some way, and usually comes with being compared or related to a technical analysis indicator, things like the RSI or the MACD, things that we'll cover another time. And so let's take a closer look at Imran's chart to see what exactly he was saying was a noteworthy divergence. All right, so now taking a closer look at Imran's chart, we can see these price candles here represent the price action for the NASDAQ. And then overlaid on top, we have this blue line, which is representing the volatility for the NASDAQ. So now we can clearly see that as price in the NASDAQ started to work its way down to these low levels, we saw the blue line had an upward outsized spike, again, which is measuring the volatility. Now, as price started to recover, started to come up from these lows, we saw that the volatility, this blue line, slowly started to work its way down. But if we look kind of right here in the middle of the screen, we could see price hit a local high and the NASDAQ started to work its way back down to the low levels that we previously saw not too long ago. However, we did not see that massive big spike that we saw the first time that we reached these low levels. And that there is the divergence that Imran was spotting, right? The trend was changing. It was deviating from where we were seeing price goes down, we see a big spike in volatility. Now, price started to work its way down, but we did not see that spike that we had seen before. And this divergence and volatility, the volatility divergence, is what gave Imran the suspicion that price might have been making a local bottom and getting ready to start a new trend, an upwards trend, which is exactly what we see here. And it went right with the volatility bottoming out. All right, so that's going to wrap up our very first Brilliant Breakdown with me, Aaron Brill, once again. And so I hope you found this a quick explainer to be helpful, but even if you didn't, please be sure to leave your feedback below. Make sure to subscribe to the Options Insight channel so you can get all the amazing stuff that Imran and the Option Insight team is putting out. And I'll be sure to catch you here next time for episode 2 of Brilliant Breakdowns. Have a good one.